Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
One stock, though, that has pretty much gotten beaten up in a big way is U.S. Steel, down as much as 8% at its lows today, Tim. Off the low, still trading more than 5% lower. President Biden blocked the $14.1 billion sale of U.S. Steel to Nippon Steel, killing a high-profile deal that we've talked about a lot over the past year or so that sparked a political firestorm and tensions between the United States and Japan. It's something we talked about to the lead up to the elections and post the elections.
Yeah, President Biden announcing his formal decision earlier today after the case was referred to him by a U.S. security review panel ahead of a deadline early next week. We've got with us a Bloomberg News metals and mining heavy machinery reporter, Deaux, who's been covering all the twists and turns of this deal. Joe, remind us, why is President Biden blocking this deal?
I think it boils down to he's seen himself as the most pro-union president of all time. He made it a cornerstone of his policy for the past 4 years. He made unions a cornerstone of how he won the 2020 election, the blue-collar workers across the states of Pennsylvania, Michigan, and Wisconsin. And I think he felt he had to follow through on that obligation. He had the support of the union leadership for the United Steelworkers, who make up a substantial amount of the steelworkers at U.S. Steel. And so he followed through on the promises that he made to them.
All right. What I love about you, and you've been in our studio several times to explain kind of whether or not this deal was problematic to U.S. national security. You know, there's a lot of history we can go into, and if you can briefly touch on it. But is this deal, if it went through, a threat to U.S. national security?
I don't think I'm the one to make a call on that, but I think what we learned through this process, and the process being the National Security Panel, CFIUS, and how they determined that there was ultimately national security is that economic security is national security. They argued that there was a chance that somewhere down the line, Nippon Steel would close U.S. steel mills in the United States for reasons to help their bottom line or to help their investors. The board just decided it was no longer worth it. And by shutting down that steel capacity, it would mean there is no longer steel capacity needed by Defense Department, infrastructure, and construction. The irony behind all of this, Carol, is that argument that CFIUS made is a direct pull from the Donald Trump Commerce Department under Wilbur Ross from 2018.
Joe, context here, $14.1 billion. We talk about a lot of money each day. This is not a lot of money in the scheme of what we talk about. I mean, Microsoft is going to spend $80 billion on CapEx for AI infrastructure this year. We just got that headline. Remind us where the U.S. steel industry is, how this deal falls into it, who its competition is, and what it is today.
It's a 100 to 120 million ton market in the United States. 65% of the steel that the United States consumes annually is made by the American steel companies. It is used in everything. It is ubiquitous. And honestly, because it is so massive in terms of volume and what needs to be shipped, you pretty much have to produce it domestically for it to make economic sense. That is why every major developed nation in the world tries to have some sort of steel industry. But like you said, when you just look at the raw numbers, it's not the tech industry. And I think that's where it's difficult, right, to have these discussions. It's like, well, wait a minute, it's just steel. We've outsourced so much of it over the years, and China's producing over 1 billion tons. But there are still some logistical reasons that you have to keep steel in the United States. Now, does that mean that CFIUS should have recommended to the President of the United States, we don't have an ultimate decision on this, it's up to you to kill it or to keep it?
Right.
I don't know, but that's where we stand today.
All right. Good stuff. And always incredible perspective on understanding this industry and maybe why decisions are made here. Bloomberg News, metals and mining, heavy machinery reporter Deaux joining us on this Friday.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, now to one stock on our radar among the biggest gainers today in the S&P 500. It's Tesla. It's up 6.7% right now. It's also, Carol, one of the companies on the annual Bloomberg Businessweek list of 50 companies to watch for a host of reasons. Some good, some bad.
For Tesla, it's actually some good reasons. Our Bloomberg Intelligence team says keep an eye on it because of Tesla's plans to introduce a slew of fresh models this year, including a lower-priced car and major refresh for its best-selling Model Y, which will help expand its reach to new buyers. Garrett Nelson is a VP and Senior Equity Analyst over at CFRA. He follows Tesla. He reiterated his buy rating on the stock. He did lower, though, his firm's 12-month price target by $30 to $530 a share. Garrett joining us from Richmond, Virginia. Garrett, good to have you here. We've been talking a lot about Tesla already in the new year. Shares jumped 62% last year, doubled the year before, nearly doubled from the U.S. election in November to mid-December, have pulled back, though, 17% since that top or recent top in mid-December. You still rated it a buy, but you cut your price target. Walk us through that.
Sure. Thanks for having me. We think Tesla has a lot of positive momentum heading into 2025. The big catalyst here, you talk about the 62% jump in the stock price. Almost all of those gains came following the election. So that was a big positive. Obviously, Elon Musk is going to have a place at the table in the administration. And, the Department of Transportation has said that one of their key priorities is going to be putting in place a federal framework for autonomous driving, and we think that's really the key to the Tesla story, and the market share opportunity longer term is with autonomous driving. So that was a big positive.
Give us numbers there, Garrett, and also give us an idea of where this technology contextually falls into place, especially compared with the other players out there, namely Waymo. How does Tesla do compared to Waymo, and how big of an opportunity is this for Tesla?
Well, we think Tesla is taking the right approach towards autonomous driving. They're using a much different technology than Waymo. Tesla's utilizing primarily cameras and AI for their autonomous driving, whereas Waymo is using LiDAR. Now, Elon Musk has famously said LiDAR is a fool's errand. It's expensive and it doesn't work. So. And we think, over time, Tesla has proven that it is taking the right approach. We think the market is recognizing that. And with each subsequent update of their full self-driving software, Tesla is making significant strides to achieving full autonomy.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We talked about this yesterday during our TV simulcast.
Well done.
U.S. mortgage rates climbing closer to 7%, threatening to squeeze buyers trying to crack into the housing market. Let's do numbers here. The average on a 30-year mortgage rising to 6.91% as of yesterday, up from 6.85% a week earlier. That's according to Freddie Mac data. Higher for longer, Carol Massar?
I don't know. It certainly feels that way. Louise Phillips Forbes is back with us. She's real estate broker with Brown Harris Stevens. She joins us here in our Bloomberg Interactive Brokers studio. We have a lot to talk about.
We do.
And we do want to first start off with, you were on with us last in September, so it was right before the U.S. presidential election. I think a lot of people were thinking, okay, after the election, we'd have more certainty, rates would move lower. We're not necessarily thinking that. What are you thinking about it? What are you hearing from people who want to buy properties?
I think that we're going to continue to see the rates hovering in this 6.5 and up, 7. And I don't think that there's enough. I don't think we're going to see that to change overnight. Remember, in 2022, we had 11 interest rate, a historical change.
Right,
and
increases.
I just don't think that we're going to see it. The feds aren't afraid to be cautious and move slower than we want. That's one of the reasons why 2023 and 2024 were difficult markets.
But doesn't it also say that the economy is not falling apart and that the Fed feels comfortable enough to say we can keep rates perhaps higher or at this level longer, and maybe we don't cut more because we're concerned about, we've got growth, but still worried a little bit about inflation?
Yeah, I think we're going to see 100 basis points through the whole year.
Oh, you do?
I think that we could see that, but I don't think it's going to happen now. I mean, like December 18th, that 25% basis points that dropped didn't even make a hiccup, right? It didn't, because it was already baked into the markets. So I think that more is going to be revealed. I think buyers are constantly, we've seen the lag of absorption.
Yeah.
But we've also seen some pieces of the market are just not going to wait anymore. It's like, I'll refinance, but I don't want to pay somebody else's mortgage. And the luxury market.
When you say pay somebody else's mortgage, what does that mean?
Well, you can pay rent, and let's just say $5,000 for your rent.
So you're referring to renting. That's just
I'm talking about renting,
okay.
and it's also when you think about, I manage a lot of property for people who own property for an investment only, and they're paying somebody else's mortgage instead of paying their own. And I always try to talk people through the few tax benefits that we get is the tax write-off for our interest rates and for the real estate taxes. I mean, I used to get a $90,000 write-off on all the real estate taxes but now I don't get that anymore. So we'll see. Because of the SALT
2017 Tax Cuts and Jobs Act.
Mm-hmm.
Yeah.
We'll see if that comes back into play. I do think that is something.
The limits on mortgage interest tax deduction.
Mm-hmm.
Right.
Right.
Okay, so what does this mean for your world? Because you're also dealing at the ultra high end
Yeah.
a lot in terms of a lot of properties. The people you work with oftentimes don't care about mortgages. They care about rates.
Yes,
for other reasons.
they do.
They don't care about mortgages.
They do, but I think one of the interesting things that we saw the last quarter. I mean, look, I'm probably more bullish than all people in the industry, but I'm bullish because I have a very wide ideal from 600,000 to 26 million, right? So I'm all over the spectrum of. So when your luxury market is bullish as we've experienced, the lower end of the market is slower. We have had more first-time buyers within my own personal team transacting this year in the last quarter than I did see the whole year.
Where are they transacting? Where are they playing?
I mean, they're buying in Manhattan, Midtown, East Side, and they are buying because they don't want to pay.
At what level of
I'm talking
sale?
From $600,000. I'm in contract for something for $299,000. So it's out there.
Right. Well, that's what help us out here and try to understand, because I think there's a point where buyers say, listen, I got to buy something, right? And I think rates are kind of settling where they are. Are we getting to that point where people are saying, I'm going to get off the fence because I think we're settling down here?
I think that people are, it's one of the reasons I've had a couple of instances in the last quarter where my appraisals did not come in because what a buyer was prepared to pay in November wasn't the same in August. So that same apartment on a lower floor, for example, in August went to contract for much less money than what we saw, the same apartment 3 floors above, 3 months later. And so the appraisal, we had to go with a different bank to get the apartment to appraise because the first appraiser was very particular. And I think we're going to see some of that.
What did you attribute that to?
I attribute it to buyers are only prepared to move forward at a certain price in the summer because we had a lag for 6 months. The market was slower.
Yeah.
The market was slower, and that took longer for people to absorb and take actions. In the fall, however, 3 people were bidding on that same piece of property.
That's interesting. Like things moved. Hey, Louise, we talk so much about New York City proper and what's going on, but you deal in the suburbs too. And I'm curious about Westchester. I'm curious about Connecticut. What's happening in New Jersey? What are you seeing?
They're 6. I think Connecticut was a 6.6. They're seeing a 6.6 growth of pricing, but not in transaction volume because people are still not prepared to move. There's no inventory. A house comes on the market, 11 offers are on that piece of property, and provided it's a clean bill of health from an inspection standpoint, those transactions are getting done. That is going to be great for New Yorkers, for me, because if if you think about the cycle of people leaving the city when their kids are whatever age,
Right.
they're going to have a lot more competition than they are in the city. And I think that's going to be an opportunity for us where we are going to see some growth, where people would have exited for the suburbs and they're going to postpone that.
I don't want to give up your surf break or anything, but you also
Please
play
don't.
you also play in the Hamptons a lot.
I play a little bit in the Hamptons.
What's going on
I try
there?
not to tell everybody. I mean, look, that's also a secondary market.
She is a
and
surfer.
I am a surfer.
love
I
that.
learned at 48.
Love that.
I attribute that to my children.
Love that.
But, you know, the secondary market's a little bit different because, you know, we have, if you look at the last 30 years of when people used to go to the Hamptons and rent for the whole season, then came Airbnb, and then people also got to a place after COVID because prices were crazy. What would have rented for $80,000 for a month was renting for $180,000. So people would go to Europe for a month.
Right.
So we're seeing a shift in that. But the
I
sales,
mean, is it normalizing what's going on in the Hamptons?
yes, the rental market is.
I mean, normal for like New York Metro, because we know it's in a whole other scale.
Yeah, it's
but
a
you know
whole
what I
nother-
mean.
it's a
But
whole nother
Get rid of the
rhythm.
pandemic impact. Like, are we getting back to pre-pandemic?
Not yet.
Not
no,
yet.
No. And I think that, you know, look, think about it. If the mortgage rates are 4% higher or 3% or 2% and you're buying a secondary asset,
Yeah.
the cause and effect of that matters more. Plus you have a 2% land tax, you know, then you have a mortgage recording tax. I mean, it's all starts to add up. Even if you're the uber wealthy, people are thinking about their assets working for them differently.
So, you know, one of the reasons we love talking with you is just to kind of we love New York City real estate and talking about it. But I mean, I don't know, what insight, I feel like you deal with folks that have money for the
Yes.
most part.
Yes.
You know, and we often talked about how we've got a bifurcated world economy, if you will. Based on what you're seeing from them, I mean, how sensitive, I mean, they are sensitive to rates. Like you talk about that.
Totally.
So
Absolutely.
do you feel like they're more optimistic about the outlook in terms of the economy and their money and where it's spent and when it makes sense to kind of make those, you don't make a big purchase unless you feel pretty confident.
I think part of that has to do with their own self-worth in their world of their market, of what they're doing. I mean, look, you think about all the kids that are coming out of college and how they're having difficulty finding jobs. But when you have a good job and you're good at what you do and you're a hard worker, I mean, that work ethic makes a difference. And those people that are 8, 10 years into that career, people bump around a lot more than my generation did.
Yeah.
And but they're stepping stones. And, you know, I'm pretty impressed with the entrepreneurials that cross my desk and these young individuals that are so thoughtful about how they're spending and how they're saving.
But I guess what I'm trying to get is an idea of what it says you about the economy. Are people more optimistic?
I think absolutely.
Okay.
I mean, look, people don't call me if they're not feeling good.
Yeah.
So
More
I think,
optimistic than the past 6 months, than the past 12
I think
months?
no matter what side of the aisle you might stand on from a political standpoint, people were looking for change. We know what that change is. So uncertainty always causes pause. But I feel like that's one of the reasons why I had a strong November and December.
Because one thing you cross off the list kind of
I
thing.
think, yeah, and I think people want to be settled.
Yeah.
Any concern about the New York City market during the next Trump administration, just in 30 seconds? Like, you know, leaders here not necessarily seeing eye to eye and then paying a price as a result of that. The president-elect, for example, wants to kill congestion pricing before it's even been implemented, for example.
Yeah, I mean, listen, the one thing that I will say, you know, about Trump is that he understands what business-friendly business is. And those policies he will be supporting, and those that he doesn't agree with, because he is not shy letting you know what his opinions are. So I was just thinking about the congestion, like, what is that going to cost me? It's going to be about $2,500 a year for me just to go downtown to show a client an apartment, you know, and I
mean, you're a small business owner.
I am.
And I do wonder, do you think that the Trump policies are going to be helpful or more hurtful?
I think they will be helpful. I think that the negotiating stance that he took on tariffs, I think that they will be useful, but could be scary if they go into play. But I think that he's got people in his ear that I think he will listen to.
And forgive me, I interrupted you about congestion pricing. 20 seconds
Oh,
left
I
here.
was just, I mean, listen, I think it's...
Just quickly.
It's going to be a challenge for a lot of people, but, listen, to try to get 10 blocks, I walk faster than I used to take a cab.
It's true.
I mean, that's the fact. But we have amazing public transportation, and people should absolutely leverage it.
The 2-3.
The 2-3, the 4, 5, 6, I'll take them all.
Sometimes delays. Louise, always appreciate it. Thank you. Have
Thank
a
you,
great
guys.
weekend. Louise Phillips Forbes, real estate broker at Brown Harris Stevens.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's see what Adrianne Yamaki has to say about it. Founder and financial advisor over at Strategic Wealth Capital, joining us from San Francisco. Adrianne, tell us about, it is a little bit of a better mood today. We've had 5 down days, consecutive down days for both the S&P 500 and the NASDAQ 100. I don't know. How are you thinking about the trade today, financial markets here in the U.S. today?
Well, it's given, the incredibly strong last couple of months of the year, a few down days in the bigger picture doesn't change a lot. And yes, it's great that today is the highest trading day of the year so far. But, I think what will be really interesting to see is coming into the new administration and just seeing what's going to be implemented will tell us quite a lot about expectations for the markets going forward.
Adrianne, I want to hear kind of a wrap on 2024 because you're out there in Silicon Valley. You serve clients with portfolio assets of in excess of $5 million, income above $500,000. When you saw new money come in last year, how much of that was about the AI boom, crypto? What was it?
My clients tend to be high-income executives, and they're quite perspicacious about the importance of being diversified. They have a lot of them came from management consulting, so they tend to think more globally.
So it's not necessarily newly minted multimillionaires as a result of NVIDIA's rise over the last couple of years.
Yeah, my clients tend to be very senior executives, and I think the balance they see is a little different than. We just saw another NVIDIA board member became a billionaire over the last few weeks. That it's interesting because the one thing we haven't seen a lot of for quite a while is proof the diversification works. And the last year, ending 2024, makes it even harder to make that case. I still think that I don't think that's the right answer, though. I don't think the answer is the concentration. If we look at the S&P, 10 companies are 40% of the market cap and even more of the 2024 performance. And the question is, are we going to be able to keep seeing performance like that? And I absolutely do not think so. And it's hard when you're newly minted because you've become rich through concentration. It can be, in my experience, hard to move from something that made you very wealthy into things that will protect that wealth. But that's pretty key in terms of retaining that wealth longer term.
Yeah, all you having the challenge of having all your eggs in one basket. If you come from a company that has done very well over the last couple of years, it can be hard, I guess you're saying, to sell those assets in order to diversify.
Yeah.
Okay.
Very hard because concentration makes wealth, and it also it destroys it very quickly.
Good point.
All right. Any new buys kind of coming on your radar that you think are kind of interesting already in the new year? And I know we've only got going, but listen, we now have a House Speaker. We had a kind of an interesting day today.
Yes.
Hakeem Jeffries laying out his vision in terms of what's the priorities for the Democrats. The House Speaker, Mike Johnson, laying out those priorities for the Republicans. There's going to be some debating going on, no doubt about it. But I am curious, as you look at the new year, is there anything top of mind for you that you're like, you know what? We're going to keep an eye on this sector or this group or this development?
Trump is going. So the reason I really emphasize the platform that Trump campaigned on versus what he's actually going to be able to execute, it's a big gray box. Also, even even if he expects to move certain things through, so for example, tariffs, are they going to be across the board? Are they going to be more surgical? What is he going to be able to do with inflation, with immigration? The reason the application and the specific policies do matter is for example, with immigration, I mean, we know that if he's even able to implement a fraction of what he campaigned on, it's going to be very expensive for hospitality, for manufacturing. So what we're looking at are breadth. We absolutely are looking at what are the companies abroad, Toyota, LVMH, L'Oreal. What are companies that are global companies, very strong? That's important to not forget.
Adrianne, thank you so much.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.